Welcome back to Raise Your Average. I'm Pierre Daly, managing editor at advisoranalyst.com. This is the Caribbean edition of Raise Your Average. I'm in the Bahamas. Mike Philbrick is in Cayman Islands as usual. And Darius Dale is coming to you from New York, upstate New York.
Upstate New York. We're in Saratoga.
Did you say Saratoga?
Yes, sir. Where the ponies run.
That's right. That's a historied place.
Yeah, we love it up here.
Saratoga Springs.
Yeah.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
So we've got a great edition for you today. There's a late summer update with Darius Dale, Chief Strategist and Founder at 42 Macro LLC. Darius, it's great to have you on. Really excited to get your update. I know things seem to be going as expected from some of our earlier discussions last year and this year. And there are probably a lot of people who thought, I told you so. But I'm thinking that you might have something different to say as well, besides the obvious, and that there are maybe some surprises, right?
Oh yeah, look at the world today. You got the U.S. dollar breaking out, rates getting new highs, the yield curve inverted for even longer. I can't wait to dig into this. What's the economic growth look like? What are the leading indicators on employment looking like, and how are they setting us up for the next sort of 6 to 12 months? I'm very keen to hear what you have to say, Darius.
Yeah, absolutely. So again, thanks for having me on. It was a pleasure to connect with you guys. If I can sort of provide a little bit of a background on kind of where we are, where we've been with respect to some of these key dynamics in the economy and markets, and then where I think we're headed, and we can unpack, obviously, at any of that to your liking. So I'll start on the growth side, at least with respect to the U.S. Since last summer, we've been very much in the camp that the U.S. economy was going to remain resilient. I think we authored that view. So not to take a victory lap, but it's certainly well-deserved because it did come from our research process. And I do believe a lot of those factors that were supporting growth at the time are still persistent. And so we do believe that resiliency is likely to carry over into the beginning of next year, which I don't think is particularly non-consensus at this point, but it certainly was going back a year ago when we authored the call. On the inflation front, I will say we have been surprised by the pace of immaculate disinflation. We obviously inflation has been decelerating cyclically, but the magnitude of the deceleration that we've seen thus far in inflation is historically anomalous. You typically do not see these kinds of this kind of positivity with respect to inflation outcomes ahead of a recession. You typically need to go into and through a recession really to get inflation to move the way that it has moved in recent quarters, which suggests it does add some support to the view that some large element of this inflation that we experienced in 2020, 2021, and into 2022 was in fact transitory. Now, there's obviously an element that it's likely to be untransitory in the sense that we have a very tight labor market, historically tight labor market by many metrics, and ultimately that's continuing to put upward pressure on wages that are well above levels that are consistent with 2% inflation. So that's sort of our second saga on inflation that I think as investors we're going to have to deal with in the coming quarters. And then lastly, with respect to policy, I don't think anything has really changed with respect to the Fed. The Fed is very much, it seems like they want to be done. The market's effectively pricing them to be done. I do believe there's upside risk to policy rates, but at the end of the day, I don't think policy rates matter as much as they have in recent business cycles, and we could talk about why that is the case here today. And then lastly, looking globally, because we don't just myopically focus on the U.S. at 42 Macro, we're a global macro, systematic global macro advisor. With respect to China, it's pretty clear that the Chinese economy is decelerating pretty markedly. I think we've had a good year, so I don't want to mince words about this, but we authored the call back in January that said, hey, if China does not sort of add large-scale fiscal stimulus to their reopening process, it's very likely that their economy was going to sort of reopen back into the structural liquidity trap that it was mired in prior to COVID, and that's exactly what we've seen on the tape this year. With respect to Europe, we have European growth starting to falter, but remaining somewhat resilient relative to the consensus narrative out there on Europe. European inflation is actually quite sticky, particularly in the Eurozone and UK economy. So that's creating a little bit of a bond market volatility, which I think has been recently augmented by the Bank of Japan tweaking yield curve control, which we think they're likely to do again in October. So I know that's a lot. We can unpack any of that and ultimately what it ultimately means for asset markets as well.
Wow, yeah, that was a mouthful. So what is underlying the persistent economic strength in the face of, structural changes in supply chains? I suppose tight labor markets would be a part of that. What are you seeing there that's making the economy so robust at this point in time?
Yeah, 100%. Mike, appreciate you asking that question. So every month we put out our macro scouting report presentation that's designed to help investors sort of get up to speed with what our systematic portions of our process are signaling, to get up to speed on some of the drivers of global liquidity and how that's likely to change and impact asset markets. And then we go through what we call our sort of modal outcome, left tail risk, and right tail risk scenarios, where we try to help investors, sort of understand the full distribution of economic outcomes. And again, we put this out at the beginning of every month. And right now, there are 10 factors contributing to our resilient U.S. economy thing, most of which are likely to be persistent for at least a couple more quarters. Number one, you have near record cash on household balance sheets. We're tracking around north of 4.5 trillion in terms of checkable deposits on household balance sheets. That number is at around 3.3% of total assets. You have to go all the way back to the 1960s to see a share of total assets that high for the household sector. We have near record cash on corporate balance sheets. So we just shy of $2 trillion of checkable deposits on corporate balance sheets. And again, this is not even including money market fund exposure. This is just checkable deposits on corporate balance sheets. You got to go back to, again, the 1970s or 1960s or 70s to see the share ratio of checkable deposits as a percent of total assets on corporate balance sheets. So consumers and corporates, the private sector in the U.S. is feeling quite rich because they feel quite liquid. Number three, we have private sector income and wealth have outpaced inflation throughout this business cycle. Obviously inflation has been a real bugaboo in recent quarters, but the reality is since the start of this business cycle, things like net worth and consumer income, nominal employee compensation, et cetera, nominal disposable personal income have all outpaced inflation, which is why we continue to see some resiliency on behalf of consumers who continue to spend. Then we have number four, we have limited credit cycle vulnerabilities in this particular business cycle. When you think about some of the things that actually cause recessions, typically you have the confluence of capital misallocation and financial tightening is what creates a recession, particularly through the lens of the corporate of the credit channel. And we just did not see the kind of adverse selection or the capital misallocation in this business cycle that we have just seen historical cycles leading up to recession. So that would suggest that we have limited credit cycle. Number five, we have limited exposure to the volatile manufacturing sector. So if you think about the manufacturing sector share of GDP, it's only 18%. Share of total non-farm payrolls is only 14%. These numbers are way down, much down from much higher ratios in previous cycles. And the reason that matters is that when you go back and you study the business cycle, particularly the drawdown in non-farm payrolls that you typically see in and around a recession, and the manufacturing sector tends to account for, on a median basis, 98% of the net job loss we experience in a recession. And obviously that number has declined as the economy's changed over time. But what it ultimately means is that we now have a more services-oriented economy, and the services sector is far less volatile from the perspective of employment, which obviously is the tail wagging the dog on the broader business cycle. Number six, we have long and variable lags in this particular business cycle. So whether you look at the duration that we're observing in corporate, the corporate credit, or if you look at duration in the mortgage-backed market as well, we're seeing duration levels that we haven't seen really since the early 1980s, and you're also seeing the spread between the yield on those indices relative to the coupon on those indices as high as it's been in several decades as well. And so what it ultimately means is that even though the Fed has hiked interest rates, people aren't refinancing or need to refinance because for two reasons. One, they've termed out their debt. We had pretty much record low interest rates going back a few years ago. But they also, folks who would otherwise look to refinance on an opportunistic basis are clearly not seeing that opportunity, given this sort of this very high spread between what they can finance at in market rates relative to what they're currently paying in coupon form. So that's kind of putting some stasis in both the housing market and in the corporate credit market from a refinancing standpoint, which just means those long and variable lags just really haven't caught up yet. I'll be quick on the last ones because they're all pretty easy. In this same concept, number seven is that we have a perfect storm for new housing development. And so if you think about this concept I just mentioned with respect to, that spread between a corporate what corporates are paying on their yields relative to what their coupons are paying, and same thing with the mortgage market. You're seeing this in the mortgage market as well, even more granular. The marginal mortgage rate we all know is somewhere around 7%, but the effective mortgage rate in the economy is somewhere around 3.5%. So what you have is an economy where no one's moving. And because no one's moving, no one's really feeling the impact of monetary policy with respect to the housing market. Number 8, you have Bidenomics. You have the government investment growing at 11.5% on a year-over-year basis. That's the fastest year-over-year rate of change we've seen in government investment since going back to the mid-1980s when Reagan was doing Star Wars. Yeah, number 9, you had a big boost in immigration last year. I want to say well north of 1 million folks. And then lastly, we have this sort of weird, funky concept that I think we're all still trying to get our hands around as economists, which is labor hoarding. We've seen a sort of influx and a big resurgence in sort of income in the economy that's allowed consumers and businesses to demand more and more goods and services, but we have not seen a big influx of labor supply. We look at through the lens of the total labor force, and so that spread between the demand for goods and services relative to the supply of people who can create those goods and services has, in our view, contributed to some labor hoarding in this particular business cycle, despite the change in policy, et cetera.
Yeah, Darius, what are your thoughts on the idea that we're in the midst of a mini productivity boom?
we are definitely not in the midst of a mini productivity boom. I want to say productivity finally got off the doldrums in the most recent quarter in Q2. I think we were trending somewhere around minus 50 basis points on a quarter-to-quarter basis for about a year and a half, and I think we popped up to around 1.92% in the second quarter. So we finally started to see a little bit of productivity growth, but the reality is, it's one, the productivity is one of the hardest things to forecast in the economy. So I don't want to make too definitive of a call on that. But the reality is, I think we need to see a lot more evidence to suggest that we have a productivity boom, or we're on the precipice of a productivity boom that might allow us to sort of, soft land the economy and have all the good stuff, in terms of getting inflation back down sustainably to 2%.
Yeah. So you don't think the sort of huge 3.7% up as reported from the Labor Department.
Yeah,
the Labor Department reported a huge 3.7% step up in productivity in Q1, and a similar increase seems very likely for Q3. Any chance of that coming to pass? I know it's outside of what the list of items that you went through.
Yeah, so there's a chance that it comes to pass, but again, I want to say this with all sincerity and humility. We as economists have no freaking clue on what drives productivity. Like it's always been a plug in most econometric models. It's like, all right, well, we know what all this stuff is now. Here, add productivity, and that's how you get the outcome you want, right? And so the reality is, we think we understand what drives productivity from a narrative standpoint, but from an econometric standpoint, and actually, being specific with forecasts, I haven't found anybody on the street that has an ability to do that. And so suggesting that we can take the last couple of quarters of productivity growth and extrapolate that, because I think it's a very dangerous thing to do. I think what's really happened over the last couple of quarters is we've seen a lot of inflation come out of the system that's sort of artificially inflating the productivity numbers alongside the broader, economic statistics, broader growth.
So in the moment, we've got a little bit of a bit of a risk-off sort of scenario or phenomenon going on, and I guess your positioning on that is that is temporary, and we should start or continue to have the reignition of equity leadership back to the cyclicals from the defensives and things like that. Just given your thoughts, and you've got that. Obviously the Chinese influence still kind of meaningful in the United States. So is it just that things are going to be lagged a little longer? Is it just going to take a little bit longer to sort of see the impact of interest rates? Often a 2-year lag between the peak in rates and sort of its impact on the business cycle and slowing things down, and then starting to show up in things like the labor statistics. Or is it that we have this sort of set of circumstances where we're just actually going to be able to leapfrog that, and leapfrog the debt maturity at some point? The rates will come down. The Fed will see that the economy is slowing and labor markets are adapting. How is this? How do you think this is going to play out?
Yeah, so I do believe this is a viable dip for the equity market from a beta standpoint. We can talk about factor dispersion secondarily. The reason I do believe this is a viable dip, because from our perspective, in terms of our nowcasting for the economy, we are nowcasted ourselves into Goldilocks, which is growth accelerating on a trending basis and inflation decelerating on a trending basis for the past 5 months. And so based on the current indications in terms of our nowcast model, it looks to be that A is likely to continue for at least another month, and B, the probability of achieving Goldilocks or reflation, which is another risk on regime that the economy can experience, is actually reasonably high for an extended period of time. And so that's, the distribution of outcomes with respect to growth is fairly flat, but it's fairly flat in the context of investors still being generally underpositioned for a soft landing outcome. And so that to me is something that could create some more right tail risk in the asset markets. I'll throw a couple of statistics out at you in terms of how to think about this in the context of what still should be a recession on the horizon as the modal outcome, albeit in a relatively flat distribution of outcomes. If you look at, go back and study the previous 12 recessions in the U.S. economy, post-war recessions that we have here in the U.S. economy, and you look at the year performance, the performance of the stock market in the year leading up to the peak prior to a recession, what we find is that it's always extremely positive. The median return is plus 16%, with an interquartile range of plus 14 to plus 20%. And so that's a pretty tight, narrow range of really positive outcomes. There are no non-double-digit values in that 12 cycle sample. And so that tells you that the market is very strong and very buoyant leading up to recessions. Probably, as my thought process around that is just bears are just getting squeezed because they put the recession trade on too soon, much like what we've seen throughout 2023. That return tends to accelerate later in the process. So if you think about the last 3 months of those observations, the last 3 months the median return is plus 9%. So over half of the plus 16% median return occurs in the last 3 months of the squeeze. And so in our view, you have to sort of time a recession in order to understand, okay, when is the market likely to actually peak for real? Whether or not, what we experienced in July was an actual structural peak, or whether or not it was a, just more peak ahead of a, run-of-the-mill correction. We have several of those every year, right? And so, in terms of what we find in our studies is that the stock market tends to peak fairly coincidentally with, kind of the employment cycle, with, kind of the peak in the employment cycle. It tends to peak on balance a median of 1 month ahead of the trough in the unemployment rate. We tend to peak on balance of a median of 1 month ahead of a spike in jobless claims. So two separate indicators from two separate agencies telling you the same thing, which is the stock market is fairly coincident, or at least it doesn't have a significant lead time on a balance with respect to the employment cycle, which means the more time we spend not entering a recession or being in recession in the economy, the more likely it is that we're likely to see right tail risk accumulate in the equity market from a beta perspective. I think the factor dispersion perspective, to me, is a much more difficult question to answer at this particular stage of the game. So this we know. We tend to see defensive leadership, emerge, later in the business cycle and into and through, kind of the early innings of recession until typically the Fed starts, responding to the recession with, rate cuts, QE, et cetera, something that gives investors hope for the new, business cycle expansion. We're clearly we are ways away from that outcome. So, when you think about defensive leadership, the market should be a defensive leadership leading into this process. The issue with defensive leadership now is that those are all the most overvalued stocks by a considerable degree. If you just look at the S&P, which obviously is generally a defensive kind of basket, given the overweight of mega cap tech and all these sort of kind of secular growth type names. The PE, I think I want to say it's somewhere north of 20 times on an next 12-month earnings basis. That's in the 86th percentile going back in terms of its historical time series. Price to sales, next 12-month sales is at 2.4. That's in the 90th percentile. EV to EBITDA, next 12-month EBITDA, that's at 13.5. That's in the 86th percentile. This is a very overvalued market from the perspective of anything potentially could go wrong from this particular starting point, right? You have a lot of stuff coming out of China, policy changes out of Japan, sticky inflation in Europe, and don't forget there's still a recession that's likely to come at some point in the next, call it 2 to 3 quarters here in the U.S.
Is there anything in the, as you say, the employment facts and figures? Is there anything there on your leading indicators that's giving you a little bit more sense there too? Like anything from initial claims or any kind of trends developing there that are giving you some insight, or is that correlating well with that next 1 or 2 quarters? We should see, unemployment rates starting to increase, and that would be coincident with some sort of peak in sort of asset prices for stocks.
No, I would just answer that with a resounding no. I mean, so we track
Okay.
a bevy of leading indicators on the business cycle, particularly as it relates to employment. Our favorite five, we have what we call our Fab Five, kind of recession signaling indicators, both to the downside in heading into a recession, but also to the upside. Kind of when you're confirming that a recession, you're certainly in a new bull phase. Although I think it's easier to do in market terms at the bottom of a recession than it is at the top of a business cycle. But that's neither here nor there. So I'll list those indicators out. So the University of Michigan has their employment survey. That number is well away from levels that have been historically consistent with recessions, entering recessions. The Conference Board has its labor differential survey. Also, the numbers, the most recent print and trends are inconsistent with kind of heading into recessions. The pattern that we typically observe heading into recessions. We look at continuing claims as a percent of the total labor force. And that number, if we track that on a 3-month annualized growth rate basis, that number is well shy of levels that it typically has reached heading into recession on a median basis. We look at cyclical unemployment, which is the total number of people who've recently lost their jobs due to either being fired or completed temporary assignments, and we track that on a 3-month annualized rate of change basis. That number is well shy of levels that we've historically observed heading into recession, and only one of those Fab 5 indicators, which is temporary employment, that number on a 3-month annualized basis is contracting at a level that is consistent with heading into a recession. And so you go back and you look at those particular 5 indicators, which are very consistent in terms of their patterns, their trends, their levels, deltas, et cetera, heading into recession. 4 out of those 5 are saying no way, no, just it's not even something we should be discussing right now as investors. I do believe at some point in the next few quarters we will be, kind of observing some of these leading indicators breaking down in an adverse manner, but we're just not seeing it yet. We have a few more. We obviously track jobless claims, the 4-week moving average there on a 3-month annualized basis, track continuing claims, the raw data on a 3-month annualized rate of change basis. We are well shy of levels that have been historically consistent with the recessions in those particular indicators. And then lastly, we get labor data from the NFIB survey, the ISM and the NFIB survey, whether you look at ISM employment, services, and manufacturing, whether you look at the employment outlook and the NFIB data, job openings hard to fill, all the kind of labor market statistics there. And on balance, they're all suggesting that we are still a ways away from a recession, albeit there's a few indicators in those particular buckets that do say things are not quite as rosy as I sound.
So now you, Darius, I was just going to ask, like you mentioned earlier that, and we've been hearing about this as well, which is the fact that, most mortgage holders in the U.S. are holding 30-year mortgages, which they might have written 2 years ago at historic lows. There was a record refinancing of credit in credit markets, in the last 18 months to 2 years when rates were still, at historical lows. So a lot of those knock-on effects of rising interest rates have quite a while to go before they start to impact mortgagees, in terms of the, nobody wants to sell their home right now because they don't want to roll into a new mortgage at today's rates. Yeah. And likewise, you could say the same thing, with corporate credit.
100%.
Right. I mean, that they're so all of those prognostications about what higher credit costs were going to do to corporate America or to the consumer have a long way to go before they actually start to, have a dire impact. It's different up here in Canada. I mean, I'm not in Canada today, but it's different in Canada.
In the background,
right? Yeah, this is Canada. It's different in Canada, right? Because we've got 5-year mortgages at best, that you can lock in. And for the longest time, people were just, most mortgagers were going with variables because they were lower than the lock-ins. And then all of a sudden, the lock-in rate started going up. So we have a much shorter term debt market for consumers in Canada than most Americans are used to. But would you say that's a very big factor, sort of this long lasting resiliency that we're seeing?
Yeah, I think it is a big factor.
That's the biggest factor.
I don't know if you could say it is the biggest factor. I think it's a big factor in terms of timing, but it's not necessarily a big factor in terms of magnitude. Not only have we avoided recession for longer than the average investor would have assumed, in terms of their positioning heading into the year, but we've also experienced a much better economy. So there's all this kind of, you have to answer it from twofold. I think this is the biggest factor with respect to the time component, but But there's also been a delta and magnitude component that needs to be explained as well that I don't believe is explained particularly with this analysis. I think what's ultimately causing that. Go ahead.
While we've got higher costs for goods, we've got much higher employment levels too, right? We've got this. So how long? I mean, that I guess maybe that begs the question. How much longer can this inflationary sort of plateau that we're at right now? How much longer can it last, and it can't go higher? And does that mean that the Fed is far from done, or not nearly as done as people think they are?
Yeah. So I think what's really happened in recent weeks is the market accepting higher for longer as legitimate policy. What has not happened, if you look at sort of the move we've seen in rates and the long end of sovereign debt curves over the last couple of weeks, really over the last month, you've seen some bloody numbers out there. Treasury yields, 10 years up like 40 basis points, 50 basis points. Same thing with the UK gilt yield. Germany's not too far behind, 20, 30 basis points. We've seen some carnage in sovereign debt markets in the last month or so. And most of it has been driven by changes in floor policy rate expectations. And so we calculate terminal and floor policy rate expectations by taking the maximum value on the overnight index swap curve out to 2 years, and we take the floor value on the overnight index swap curve out to 2 years. And what we've seen is that there's been hardly any change to any of these major, central bank major central bank policy rate expectations on the terminal side. But we've seen dramatic moves in the last kind of 4 to 6 weeks on the floor policy rate side, and this is across the board with the U.S. leading the charge. And so what's happened is, go back to late July where we're getting confirmation of GDP, accelerating again, and obviously following up with the labor market report and the ISM numbers, and you got the CPI numbers a couple weeks ago. You've had a lot of information that's really confirmed what our models have been confirming for the past 5 months in the U.S. economy, which is the U.S. economy's been in Goldilocks in terms of our nowcast systems. And so as a function of that, investors are looking around and saying, not only has the recession not started, the economy is just doing just way better than anyone would have expected, and I think, I would take myself out of that because I think we expected a lot of this economic resiliency that we've observed this year. What I think has really been instructive on the fixed income side is a couple of things. So you started this year with like markets pricing, or not this year, but you go back to maybe I think the height of the regional banking crisis back in March and April, which, by the way, barely had any impact on credit statistics, which was their first tale going back. And if you look at the H8 data, and that was an H8, the balance sheet data, the H8 data that we get every Friday we were looking at this for like a month after these banks went under. It was like, it doesn't look like a banking panic, It looks like a lot of guys got on podcasts and tried to sound smart, like including myself for like a week. But the reality is it just didn't materialize in the data. And so from that point, we saw a few things that really, really concerned us about, kind of sovereign debt markets, and we made a pretty bold call, saying, hey, like you need to sell bonds. And this is going back to early May. We said the pricing on the sovereign debt curve in terms of what investors are pricing in for rate cuts was preposterous relative to the observations that we were observing in the economy. We had about 200 basis points of rate cuts priced in for the Fed versus only about 100 basis points for the ECB, Bank of Japan. We're like, that number's got to change. One of them is wrong, right? Fed's not going to cut 200 basis points, and these guys are only going to cut 100. Either we need to cut 100 basis points less, or they need to cut 100 basis points more. We thought that the less was the more likely outcome given the resiliency of the economy. Number two, we have this very unique starting point in the bond market, which is very anomalous to history. Not only obviously are yields just nominally low, but part of the reason yields are so nominally low is that we have this negative term premium environment, which is very unusual. We typically have positive term premium. We've only had negative term premium in the QE era, going back when we made that call in early May. We were saying, hey, look, investors are they're still overly positioned for recession. I think bonds are going to go down a lot, stocks are going to go up a lot, and we made that call back in early May. But focusing on the fixed income side, term premium were about minus 60, 70 basis points at that particular time. You had 10-year break-evens, tracking around 2.25% that time. The bond market was as priced to perfection as anything I've ever seen in my career. folks want to be concerned about a 20 times equity market, fine, that's whatever. But a bond market with those kind of pricing statistics in the context of an economy that, according to the Atlanta Fed, is growing somewhere around 6%, which obviously is wrong, but that number could still come in around 3 to 4%, and inflation that is looking like it could easily stabilize somewhere in the 2.5 to 3% range. I just didn't see the possibility that bond bears, bond bulls would get paid anytime soon, and that's why we made that call back then.
You mentioned earlier, too, about policy rates maybe not being as important as we started off the show. Maybe can you dig into that a little bit more, or have you sort of covered that, or maybe explicitly cover it?
Yeah, let me show you a chart on that particular this particular subject. So let me put my chart up here. Yeah, gotcha. Yeah, so there is a so if you go, so what I'm showing in this particular chart is I'm showing the Bloomberg Corporate Credit Index for the U.S. economy, the credit aggregate. So for corporate credit, to show the duration on that statistics at 7.3. It's down from about 9 a couple of years ago, but 7.3 is basically as high as you got to go back. You got to go back to the late 70s, early 80s to see a number that high in terms of the duration of that instrument. And so it effectively tells you is that corporates have turned their debt out, which means their maturity walls and their need to refinance into this higher rate regime is just lower, is as low as it's been in 40 years. And so that's something we need to be aware of as investors.
Yeah.
Number two, if you look at the spread between the coupon and the yield in that particular index, it's at 166 basis points. You got to go back to 2008 to see a number that high. And prior to 2008, you got to go all the way back to the early 80s to see a number this high. And what that ultimately means is that not only do we not need to refinance because the duration is so high, but we wouldn't refinance anyway if we got an opportunistic chance to do so in market terms, because it's just a lousy opportunity to refinance. If I'm refinancing, I would have to pay a much higher yield on new debt relative to what I'm currently paying in coupon terms on my existing debt, which means I'm not going to refinance so neither by hook nor crook are corporates coming to the market to do anything and that will push them into this new higher interest rate regime. It's just going to take longer. And the same, everything I just said with the corporate sector, you can just repeat for the household sector with respect to mortgages. The duration in the mortgage, the Bloomberg Mortgage Index is as high as it's been since the early 80s as well. And then the spread between the yield and the coupon on that particular index is as high as it's been since the early 80s. And so, again, you don't need to, folks who have mortgages don't need to go to the market to refinance because their duration is as long as it's been in a long time. But even if they wanted to, for economic reasons, it doesn't make any sense because they're going to be, refinancing into a much higher interest rate regime, and that just obviously that's not very rational to do. So, it's our view that this process it's going to happen, and folks in terms of being dragged into this higher interest rate regime, over as time progresses, it's just going to happen slower, given the starting point of extremely long duration for these instruments, and this now the speed with which the Fed tightened policy created this very big spread between what folks were paying and the yield on those particular instruments. And so I don't think rates, it's not that rates do not matter. It's just that they do not matter today in this particular window of time. They will matter eventually and increasingly as we go forward in time, but it's just, you have to understand that, these are some of the things that make that, this sort of long and variable lag component of Fed monetary policy, it really did cement that in this particular business cycle.
It seems that it was interesting that the mortgages haven't had this duration since 1982. Yeah. That was a high interest rate environment.
Yeah.
And people were extending their duration then. That's probably they may have had to, just given the circumstances. Very interesting.
Well, think about it.
Isn't there a slowdown impact on some of corporate credit, and the markets are available at higher rates? Certainly going to have higher hurdle rates in order to justify any new financing. I mean, notwithstanding financing projects that already have. Yeah. Does that? It's got to have some sort of slowing impact on the economy, but I guess we're not seeing it. So I guess why fuss ourselves until we see it?
100%. I mean, if you look at, let's say, corporate debt divided by the total assets is only somewhere around 40 or 50% for the U.S. corporate sector. Their floating rate debt's only about 33% of total debt. There's just not this big, great glaring need to go spend a lot of money to do a bunch of stuff, right? That just is what it is. And so, don't think about, the economy. And we have a lot of public sector investment as well. So the government is levering up its balance sheet to, create investment in the economy with the CHIPS Act and the Inflation Reduction Act. And I'm sure there's a bunch of other acts that, we're all paying for as citizens. So, hopefully we're getting our money's worth on it. But that's neither here nor there. But the reality is it's just not like this sort of concept of a maturity wall and all this other stuff. It matters. It just doesn't matter on the duration that folks need it to matter on. And that's the only thing I'm trying to say here. It's that, yes, everyone's right about what they feel about the economy. It's just you have to respect the x-axis on some of these business cycle processes.
Yeah, being right and early is being wrong.
Yeah.
Yeah.
Yeah. Anything in the housing market that you want to highlight because we did talk about a little bit of that in your 10 points, but is there anything further in the housing market that either
like new homes, first time home buyers, what's
100%.
happening there? Yeah.
So this is it's the number 7 actually in terms of that list. Perfect storm for new housing development. So I'll walk you through this chart in terms of how we get to that conclusion, which is if you look at household mortgage debt as a percent of nominal disposable personal income, we're only at 63 cents on the dollar. So that's kind of de-risked relative to where we were in previous cycles. The mortgage debt service ratio is only at 3.9% of income. That number's, preposterously low. Like the Fed would have to take rates to like 10, 20% for that to really matter in the duration that a lot of investors are positioned for it to matter today. So that's obviously not, an issue for now. It'll eventually become an issue with time in terms of respecting the x-axis. But I think the real interesting stuff starts in the second and third panels. So in this spread spread plot here, we show the spread between the effective mortgage rate and the marginal mortgage rate, and it's about 350, 400 basis points wide. If you look at the red and blue lines here, and so in our opinion, that spread is effectively, to your point, Pierre, is really creating a lot of stasis in the housing market, right? No one. I don't know too many people who are dumb enough to trade a 3.6% mortgage for a 7.32% mortgage. I'm sure none of like, if you know any of those people, let me know, because I have stuff to sell them. I have like a closet full of old clothes I'd like to sell them. But the reality is most people aren't that dumb. And so I got some suits that don't fit anymore from COVID. But anyway, and so the reality is because of this stasis that we're seeing, folks aren't putting their existing homes on the market. And so we're seeing this sort of response from the builder community on the new home sales side. This blue line in this chart, which is now this ratio is at an all-time high, is the housing starts to existing home sales ratio. So it's the total number of housing starts as a ratio of the total number of existing homes being sold. And we're seeing that folks are just rushing in, builders are rushing in to meet this sort of, kind of supply and demand imbalance in the housing market. Because again, don't forget, consumers are still flush with cash. They still have cash to do things with. That's why, you're still seeing bidding wars in most major metropolitan areas for houses. There's just this, funky dynamic going on, which is a perfect storm for new housing development. Builders have to rush in to meet this demand because we know we're not going to get the existing supply. We're not going to get the supply from the existing home sales community.
Right. Isn't that Buffett's play? Didn't he buy home buyers recently or home builders recently?
Yeah, no, Buffett's obviously, I was just about to say, Buffett's obviously a better investor than me, but that'd be the dumbest thing I've said in a long time because I don't need to waste those words. Obviously, Warren Buffett is a better investor than me, but the reality is we put out this information going back to the fall of last year. Yeah. We didn't make any money on it. I wish I bought home builders back then. We had clients who bought home builders and were high-fiving me for that, but like the reality is, the investing is always your two parts. Getting the fundamental call right, but I think so much more of investing nowadays, particularly since COVID, and we're kind of in this, what I want to say, kind of hyper-focused market environment, market regime, where it seems like news gets priced in faster. You have zero DT options that are kind of creating a lot more intraday volatility for equities, and not just for equities, but for all asset classes and stuff, because we're all correlated right these days. And so I think as a function of that, the behavioral side of investing has really, kind of come to the forefront, and what separated a lot of folks from making money in the last couple of years, or at least the bare minimum last year, not losing too much money. And I think, knock on wood, we've done a pretty good job for our clients in both respects, both to the upside this year, but also to the downside last year.
Do you think, on a go-forward basis, from a portfolio construction perspective, when you think through what's happening now currently, just a robust stock market, bonds overpriced, having a bit of a correction during that time frame, an inflationary regime potentially changing or altering what has been a largely negative correlation between stocks and bonds for the last 20 years, which is actually the unusual part. It's more usual that they are correlated, and often in these inflationary regimes, they tend to be more correlated. Walking it forward, do you see the passive bond portfolio sort of in that 60-40 mix being as resilient as it's been in the last 20 years as we approach the potential for a coming, just even a garden variety recession?
Nope. Nope. Yeah, so that's like the quick, funny answer for that, but I'll give you a more sophisticated answer for sure.
Like that was like the second you stopped talking.
Nope
like,
is good. That's good.
Nope. So I believe at this point I'm now the I don't want to say the godfather because I'm not that old, but like I want to be the face of the 60-30-10 approach. That's how we manage that money at 42 Macro in terms of our systematic KISS portfolio construction process. I'll speak to that later, but I do want to take before we get into that, talk about kind of some of the things you alluded to, Mike, with respect to this sort of new inflation regime. So you hit on a couple points that I think we've all studied a lot of the same data in terms of helping us get to, which is when inflation's high, and what we mean by high is in the north of 3 to 5%. That's kind of the threshold where inflation starts to, where the market starts to behave differently from a correlation risk perspective in terms of stocks and bonds. Like when you have this sort of like 0 to 2 and 2.5% inflation regime, which is what we've experienced for a lot of part of the last 30 to 40 years, but the reality, not 40 years, but the last kind of 25, 30 years, that's typically where stocks and bonds are inversely correlated because the only thing that really matters in that regime is growth, or it's growth, you know what I mean? Like you could take your mind off inflation. But when inflation is below zero or above zero, you tend to be, materially above that threshold, then you typically see positive correlation. And this is data going all the way back to the 1800s. As we're citing the case, the data we performed analysis on with respect to Case-Shiller. So we have to accept the fact that if we are potentially in a higher inflation regime, potentially one that is with a 3 handle as opposed to a 2 handle as the underlying kind of trend of inflation, we need to accept the fact that we might have this persistent positive correlation, or at the bare minimum, not inverse correlation like we were so used to, kind of in the 60-40 era of dominance in the last kind of 20, 25 years. So in this chart here, I'm showing our secular inflation model. And what this model is designed to do, it's a dynamic factor model that's designed to project the underlying trend of inflation. And so how it does that is capturing delta adjusted z-scores for all these various factors that we've shown in our work to be either correlated or co-integrated with the underlying trend of inflation. And what we find is that, when you kind of look at, when you summarize all those, those factors and deltas, relative to the previous decade where we had inflation trending at 1.6%, and this is core PCE inflation, our model is suggesting that trend, based on the movement that we've seen in these variables in the past few years, is somewhere around 2.5 to 3%. Now, that doesn't sound like a lot, right? Like 1.6 to 2.5 to 3% is like, whatever, who cares? And if it's 2.5%, I actually don't care. But if it's 3%, or if it's higher than 3%, if there's forecast error to the upside, and I think commodities could easily take you to forecast error that's to the upside on this particular projection, then we're talking about the underlying trend of core PCE that the time series oscillates around is going to go from 1.6% to 3%. Which ultimately means the Fed is either going to have to change its inflation target from 2 to 3% in order to maintain their ability to be an active participant in financing the Treasury, which I believe they're going to be forced to politically, by hook or crook. And if they don't change their inflation target, then they're going to be consistently and constantly leaning on the economy from the perspective of tight monetary policy in order to create the demand for bonds that way. They're either going to use their own balance sheet to create demand for bonds in terms of helping the Treasury, the fiscal authority, finance and capitalize itself this decade, or they're going to have to destroy the economy and make us all want to be long bonds anyway because they're constantly leaning on the economy. So I don't know how they're going to choose to do this. I think in a fourth turning regime, it's very likely that these guys are going to have to just change their inflation target and get with the program because I don't really see any really ability for any government, whether it be monetary authorities or fiscal authorities, to implement material austerity in this particular decade. And so that brings me back, Mike, to our conversation about portfolio construction. So we've implemented, earlier this year we introduced a systematic portfolio construction process, loan only for our investors. It was kind of with the exception, it was kind of, so had a great 2022. Worst quarter of my career in Q4 of 2022. Like just everything I said and did was wrong. If you took the opposite side of it, it was kind of like, was it George Costanza in Seinfeld?
Bizarro World?
Bizarro World, yeah. Everything I said and did was wrong for like 3 months.
Opposite.
And so, kind of using that as an opportunity to get better as an investor, we went back to the drawing board and we actually kind of, say, hey, look, what I'm best at doing is building, quantitative models that work and ultimately are backed by, proven quantitative techniques. And so we built and designed a, soup to nuts, long only investment strategy that is designed to help investors outperform that kind of standard 60-40 approach with the idea that, hey, look, I don't think 60-40 is going to work the way it used to. You have trillions upon trillions of dollars of assets out there that are, kind of to some degree are mimicking or explicitly, sitting in some form of 60-40 or 70-30 or 80-20 based on the trillions of dollars that have been accumulated in target date funds in recent decades. And so in our opinion, just if all you did was just did 10% less bonds, in our opinion, given the starting point of negative term premia, 2% expectations as far as the eye can see, rate cuts priced in as far as the eye can see. I think if all you did was just did 10% less bonds and put it on the short end of the curve, you'd probably significantly outperform. But we have obviously other, elements of this particular process, whether it be our top-down risk management overlay, where we use our weather model to infuse volatility targeting to the strategy. We use our bottom-up risk management overlay in terms of our volatility adjusted momentum signal to infuse dynamic position sizing into the strategy. And ultimately, our bottom-up kind of grid regime forecasting and nowcasting tools allow us to understand the factor selection that should be associated with this as well. And so we've backtested everything that ticks through the lens of factor dispersion, annualized expected returns, percent positive ratio, volatility, covariance, expected Sharpe ratios. We summarize all that here. And ultimately, this is our, when we think about that 30 and that 10 component, because we were totally fine accepting beta as our cherry for the 60 part. But what we're not fine with is accepting fixed income beta as the 40 part. And so we use this process again, in conjunction with our weather model and some of the other quantitative tools that we use to help investors manage, macro cycle risk, we use those tools to help us identify the right factors in fixed income, the right factors for that 10% quote unquote macro bucket that will allow us to consistently outperform 60-40 going forward. So I think this is a better mousetrap for what I believe will be increasingly proven to be an antiquated investment strategy that was born on this really kind of perfect storm of outcomes for the past 25 to 30 years.
Yeah, I think we actually have discussed this on some podcast somewhere, the idea of pick 60-40 a couple of years ago. Just talking about the fact that we may have seen peak 60-40 both in its efficacy, Sharpe ratio, and maybe adoption, but it always takes time for these things to bleed through. I often think of the framework that Marqeta provided with their RMS, their first responders, second responders, and diversifiers. We are in that same sort of global macro camp, right? Our products can incorporate shorts as well, which is a nice additional suite of potential outcomes. But the first responders are sort of that long volatility and long duration type sovereign bonds, right? But if you're not going to have the opportunity to benefit from those long duration bonds, which have been such a core piece and such an effective piece for a couple of decades, well, what do? Well, the second responders are those trend followers, those CTAs, those global macro areas where you're thinking through the potential causalities and relationships, as you've pointed out, and actually having some allocation in your portfolio in order to provide that ballast of diversification. We've started on a path of return stacking as well, which is building a suite of products where we layer in on top of the beta, the managed futures trend, in order to try and alleviate the tracking error, which I think is a problem as we transition from 60-40 to this new world. But what'll happen then? It'll be like, well, what do I need all this beta buried into my good stuff for? And they'll toss that away and they'll be like, give me the global macro 100% on its own. 60-40 is dead. As always is the case as we go through the experiential learning as investors do. But I think that framework is, like you say, keep it simple, keep it systematic. That's beautiful.
Yeah,
love that.
Thank you, man. Yeah, no, you're 100%. Like Man Group did a big study on this. Their work is backed up, I want to say, by AQR as well, which is trend following is the best strategy for an inflationary era. Now, again, if we're trending at 3% core PCE, we can have a discussion on whether or not that's an inflationary era. I suspect it will feel like an inflationary era, given the starting point of negative term premia in the bond market, right? Like that will feel like an inflationary era in the context of a bond market that thinks 2% is the norm, and it's okay to have negative term premia. You could easily see term premium back up another 150 basis points from here and be totally normal. Like that, we could go to 550 on the 10-year for no reason other than term premium backing up, and that should be normal. People would freak out and lose their minds if that happened, but it would be very normal. So, like, as a matter of fact, let me just show a chart of term premium so folks can get to understand what I mean by this. And so I had this chart on our deck for quarters now, and I keep having to explain the same concept to bond bulls, which is you're buying a market that's basically like 1,000 times the earnings, and so this shaded area chart shows the term premium for the 10-year. And again, what term premium is the excess return you get as an investor for locking in your money on a specified duration relative to the return you would get for just rolling over, shorter term debt for that for that extending period of time. That's different from the term spread, which a lot of folks are quoting for with respect to the business cycle. 10s, 2s, 10-year, 3-month. That's a little bit different. This is more of a wonky concept. And so we been into the last kind of 4 or 5 years in this really negative term premium regime, which is like, you go back to the late 80s, and again, we're not going back to the late 80s, the early 80s. Term premium peaked somewhere around 500-600 basis points over. You look at a mean on this chart, it's probably somewhere around 250 to 300 basis points in terms of where term premium are. We're at minus 37 basis points now. So again, we could back up like 250 basis points just to get to the mean in something that is really technically not being controlled by, policy expectations, inflation expectations. This is purely just, what has become a supply and demand imbalance in the treasury market because central banks have been responding to slow inflation, by, consistently and persistently, expanding their balance sheet and their overall share of these sovereign debt markets. But I think that's likely to change unless the Fed, if our structural inflation model is right, and calling for, let's say, the high end of that forecast range is accurate. And we are now trending at 3% core PC inflation, which is actually where we are currently. If you look at it on a 3-month annualized basis, we're at 3.3%. We're at 3.2% for Supercore. We'll get the numbers next Monday, I think next Monday or Tuesday to confirm that. But, that's kind of where we are today. But if we don't go much further below that, folks are going to start to get concerned that 3% is the new 2 in economic terms. What happens if 3% is not the new 2 in policy terms? If the Fed doesn't respond to that, then they're obviously going to be leaning against the economy and financial markets. And I just don't think they have the political will or desire or they will be able to do that and get away with that in this fourth turning decade. I think they're going to have to, kind of acquiesce to this, this demand for populism, whether it be through monetary or fiscal policy from all these Western nations.
Yeah, and a good plug on for Neil Howe's updated
my former colleague
book.
Neil, his new book.
Great stuff. So we've got about only about 3 or 4 minutes left. Is there anything that we didn't think of asking you, Darius, that you would be eager to put out there as we wrap?
Not necessarily on the market prognostication front, right? Folks, we publish research 6 days a week, sometimes 7 days a week here at 42 Macro. So if folks want to get our research and our market prognostications, they can certainly come check us out at 42macro.com. But I think just from the perspective of to me, what's been very instructive in helping me, generate positive outcomes for our clients this year, I do want to, there's not a large list of bulls who were bullish earlier in the year, but when we pivoted bullish back in January, I want to say that was a pretty decent call relative to that. We got incrementally bullish in early May on the stock market, got incrementally bearish on the bond market in early May. These are some big calls that were made, and they're all based on the process. But that's not why we're here, right? What I'm trying to do is a lot of those calls came from is going back to the drawing board during that dark malaise I was having in Q4 of last year, and really reinventing myself and focusing on the behavioral aspects of my process, really reorganizing my process, figuring out what to weight higher in this whole, kind of scheme of things that we do from a research and risk management signaling perspective. And so the last thing I would say to anyone paying attention to this is just go back and focus on yourself as an investor. We spend way too much damn time trying to figure out what is going to happen in the economy, what's going to happen in financial markets. And the reality is less than 50% of what you hear is going to become true. Right? So as opposed to just take 100% of that time, cut that time you have in half, and then work on yourself as an investor. And I guarantee you will have better outcomes than someone who just spends 100% of that time consuming research that only 50% is going to be true.
Wise words, 50% at best, I bet.
At best. No, I'm being very kind. I'm being very kind.
when you put that in simpler terms, that's literally a coin toss.
Yeah, totally. Yeah, exactly. 100%.
It's so random.
There's lots of research that shows that it's slightly worse than a coin toss. But anyway.
Totally. Not even a coin toss. Exactly.
You guys are quants too, so you understand
you're not even likely to get a coin toss result. Exactly. That's pretty good.
Exactly.
That's a great recap. Thanks, Darius. Thank you so much. That was a fabulous roundup of this year's economics and your outlook for the coming period.
Appreciate that. Thank you so much.
Great to have you. Terrific to see you again too.
Likewise, man. Enjoy your vacation.
Thanks, sir.
Mike, appreciate you guys. Thanks so much. I'll catch you guys next time.